There is one question every investor must ask before they invest. How can we get the highest return for the lowest amount of risk? We call this risk-adjusted return. My advisors and I believe that value-add real estate can give the highest risk-adjusted return of any investment. Disclosure: Westrock Equity and its members do not provide investing, legal, tax, or accounting advice. This is for informational purposes only. This is not an investment offering, and you should consult your own advisors before engaging in any transaction. Weston, what is value-add real estate? Value-add real estate is pairing renovations with organic market growth to outpace traditional investments. But there is a certain way to invest in value-add real estate. This helps us avoid mistakes and make higher returns while doing no work, just providing capital. It's called private real estate investing. In private real estate, you partner with an experienced operator who does all the work, renovating and operating the properties you invest in. Most of the money the operators make comes from the back-end sale, not from fees. This highly incentivizes them to perform for their investors. On top of that, they often invest a significant amount of their personal net worth alongside their investors. This creates an alignment of interest with investors. Why private real estate? There are many benefits to investing in private real estate, only if you do it the right way. Real estate offers protection of capital, high velocity appreciation if you pair forced renovations with organic market growth, like I was speaking about earlier. It offers an alignment of interest with the sponsor that you're working with if they invest a significant amount of their net worth, and they receive a fee structure that aligns interest with them in order to incentivize them to perform on the investment. Private real estate offers cash flow growth long term if you do it the right way, low volatility, and it's not correlated with the roller coasters of the stock market. It offers tax benefits such as depreciation and 1031 exchange. And just a disclaimer, I am not an investment or tax advisor, so please consult your own advisors. And investors can diversify in multiple properties if they wish to do so. How private real estate investments can outpace traditional investments. If we pair organic market growth with renovations and operational upside, we can exceed expectations because we're putting value into the property ourselves and not only relying on organic market growth. We can also see operational upside by improving management if the old operator was doing a bad job. If we buy in a property with high growth, we get higher appreciation on the back end. We just want to make sure we're not overpaying for the asset, and we also get the high growth of the market as a whole. If we pairing organic market growth with renovations will dramatically boost returns for investors. How we protect the downside. We work with the right operators who have an experienced track record, a professional team, and a consistent ability to renovate properties on schedule and on budget. We want an alignment of interest with the operator through the fee structure and how they structure their deals. We also utilize low leverage because we don't want to put too much debt on the property and carry that additional risk. We also want to have a high debt service coverage ratio so we can make sure we're covering the loan. We also want a low risk break-even occupancy. What this means is we analyze the property and see how many people can leave, and we break even on the property. Here are more ways we protect the downside. We purchase property with below market rents with loss to lease and renovation premium. The goal is to buy at below market rents and raise rents to what comparable properties are. We want to be in a market with population growth and diversified job growth. The word diversified job growth is important because we want to have multiple industries that are supporting the jobs. Because if we go into a recession, if we're reliant upon one industry or one company or a low number of companies, we can carry an additional amount of risk in our investment. We also want significant reserves at the property level if anything unexpected goes wrong. Here's what we look for in operators. We want to see a track record of experience in the asset class that we are going after and the local market that they are investing in. We want to see transparency in their reporting. We want to see an alignment of interest with them. This mainly comes through their fee structure and their personal money that they're investing into the deal alongside the investors that they're raising money from. And we want to see properties that fit our criteria. Here are some private real estate tax benefits. Just a disclaimer, I'm not a tax advisor. Please consult your own advisor for more information. Private real estate offers depreciation in which you can utilize passive losses to offset passive gains. This reduces investor tax bill at the end of the year. If you or your spouse qualifies as a real estate professional, you can write off against active income. If you want more information about this, please reach out to me. Investors often pay little to no tax on cash flow. For example, if you make the same cash flow from real estate and a stock dividend, cash flow from real estate will be worth more after tax because of depreciation, only if you use real estate investing the right way. We also utilize a 1031 exchange, where we can reinvest into another deal tax-free. This further accelerates returns because investors don't have a tax burden. Here's why people invest in private real estate. Private real estate offers an alternative to the stock market. It offers cash flow growth, depreciation tax benefits, and people want to invest in the real estate, but they don't have time to manage everything. This helps them focus on their own business or their own job and increase their income there to invest more into real estate passively. Here's why people don't invest in private real estate. I wanted to put this in here for transparency with investors, just to make sure they're aware of everything. Private real estate is illiquid. It's not like a stock where you can pull your money out anytime. You have to wait for the sponsor to sell to pull your money out, or you wait for them to sell and then you reinvest the money to increase your cash flow and increase your total long-term growth. It is also a limited partner investment, which means you don't have control over the property. This goes back to what I mentioned before about the operator, and it's very important who you work with. Here are some final suggestions. Do your due diligence before investing. Look at all of the information, not just one metric. It's important that you do all of your research before investing your hard-earned money. For example, investors only looking at IRR returns will increase risk because they don't know the other metrics of the deal or what it includes with alignment of interest with the sponsor and all of the other things that go into analyzing a property and a private real estate investment. Scan the QR code if you want to learn more about private real estate investing, or click the link in the description. Thank you.